The Darwin Innovation Hub, creating pathways to the future.
Okay, hello everybody. We're going to do a quick webinar on funding alternatives. This will just be a quick 20-minute presentation so that it can be done quickly in a lunch break or in a few minutes of your spare time. So let's begin. Most businesses require funding for a multitude of reasons, so it's important to understand what is the best funding alternative depending on your requirements. Capital expenditure can refer to plant and machinery or factory or land and building. Working capital refers to the funds needed to actually be operational. So does this need to cover salaries, marketing expenses, establishment of supply chains, etc. Retiring debt is when you want to knock over a term loan repayment. Expansion funds are for when your company wants to commercialise operations into international markets or create new product lines. And acquisition finance, in line with your exit strategy, is either a leveraged or managed buyout plan. There are, of course, also different stages of business in which you would require funds, and different funders are relevant to these stages. Here we have the ideas stage at the front. This is relevant for incubation type funds that come from micro grants or companies putting money into seeding of ideas as part of a research and development team. When those ideas start moving into development, they become a micro business and then usually funded by angel investors or venture capital. Once commercialised, they would move into the middle where they would hopefully become an SME, and then the best funder for them would be venture capital, private equity. A mid to large size business would look towards, again, private equity or even capital markets. And once mature and an exit strategy is ready to be realised, they would look towards the acquisition finance we spoke about before, where they would either list or become publicly traded or be bought out. So let's then start at the beginning and at the ideation stage. And governments, they really love to support innovation, particularly when there is research and development and a university or research institute can get involved. The R&D tax incentive is designed to assist businesses who are conducting innovative and experimental activities in order to create novel products and processes in the science and technology space. The current value of the tax offset for SMEs is 43.5%. The AC grant, or Accelerating Commercialisation Grant, that is an element under the Entrepreneurs Program, and it's a competitive grant of up to $1 million to help you successfully get your product to market. And the Export Market Development Grant offers a 50% reimbursement capped at $150,000 on activities to globally commercialise. And then, of course, you have the state-based grants. And in the Northern Territory, the Department of Trade, Business and Innovation have the Business Innovation Program, which provides $30,000, as well as mentoring support for entrepreneurs whose innovative idea provides a direct value back into the territory to assist them to commercialise. There are many other programs that provide support, such as the other elements of the Entrepreneurs Program. CSIRO have grants or assistance through research institutions. Reach out to development commissions, Oz Industry, your regional development authorities. And the federal government has also come out with the Boosting Female Founders Initiative, which is a grant program for startup companies that are at least 50% owned by a female. So I encourage you to do some research into what is available on a federal, state and local level for you. Now we'll look into what the different types of funding are aside from government, and the first would be crowdfunding. Crowdfunding is commonly done online using platforms to raise project capital from a large number of individuals or the crowd who donate small amounts of money. In exchange, donors receive equity in the business or a reward such as a discounted price of the product, which is made first available to the donors, or supplied in exchange for a nominated donation value. It is an alternative funding source to diversify the startup ecosystem, so for the general public and investors to actively be informed and to turn them into ongoing customers and advocates that will contribute to the economic growth of the company. Investors look towards crowdfunding platforms in order to prevent missed opportunities and to expand their investment portfolio. There are 4 different types of crowdfunding. The first is equity, and this is where the entrepreneur sells a share of their business in exchange for capital. There's debt or peer-to-peer lending. This is where the lender expects a repayment with a return, though the rate of return is usually lower than traditional lenders. And then there's reward-based, where you will provide the donor with product or a discount relative to their investment. And charity, where public donations are called in a bid to collect funds for a project or charitable cause that provides more intangible benefits, such as investor satisfaction from providing some goodwill. The advantages of crowdfunding is that it opens up access to startups and diversifies the community without losing exclusive decision-making abilities in your business operations. It really allows the entrepreneur to test the marketability by the amount of interest they receive from donors, and it allows anyone the ability to invest. So this mitigates the need for investors to be classed as a sophisticated investor when looking for capital raises. On the downside, however, the entrepreneur really needs to make sure that they have the right patents and copyright protections in place in order to avoid IP theft, because this is a bit easier to happen in crowdfunding, as you're essentially marketing your product and makeup to the world, opposed to a closed room deal discussion. The marketing efforts are quite high as well, meaning you need to place a lot of effort on marketing to larger than usual audiences in order to create and gather that crowd. And then there are also admin fees and commission fees associated with the platforms that you use. And another thing to note is that most crowdfunding platforms return the money to the investor if your minimum targets by the set deadlines are not met. So again, it pays to do research when looking at which platforms to use and do a comparison of the fees and terms and conditions there. Another source is an angel investor or a business angel. And these are people who supply capital, either debt or equity, with their own money, funding businesses which are operated by those who are not a friend or family member. Business angels are wealthy individuals who can possibly have stakes in ownership and be active in supervising the company. For developing companies, securing money from a bank is quite hard to achieve, and this is where the role of the angel investor comes in. They are one of the largest funders, particularly in comparison to venture capital. The benefit of an angel is they are the ones that fund you at the pre-launch phase, when all the money from the family and friends is dried up. This makes the angel quite crucial as they start to fund that development stage. They are vital for seed, early stage and second round phases. Originally, actually, VC would fund second round phases, but over time, VC has been shifting towards later stage developments, and this has created a little bit of an equity gap. Angels can commit anywhere from 10,000 up to 100,000, and there's normally an average of around 75,000. They normally hold the investment for around 5 years, and they do understand that the investment bears high risk, particularly as they're investing in a startup. Through this money, though, also comes a wealth of knowledge that they can provide, such as managerial and technical aspects of operating a business. This can consist of providing strategic advice, such as planning and generation of new ideas, as well as supervision of management and assessment of assets. They also have access to a broader range of networks and other potential investors, particularly amongst the whole angel investment network. 40% of angels invest in seed and startups, with the others investing in early stage. The commonalities, of course, being that the investments are almost always made into those industries with a high growth potential, such as software, healthcare, biotech, energy, and ICT. So if you are in the early stages or in these high growth areas, it is worth reaching out to angel investment networks for advice and making it to one of their pitch nights. Private equity funds, these are a collective managed investment scheme. And I've put a list there on the screen, or a link for you to have a look at to find the whole list of Australian VCs. It is an alternative investment class and it's a relatively new concept. Private equity funds invest directly into the business and rely on their general partners to make investments that increase in value. A list of private equity funds can include the likes of Bain Capital, Insight Venture Partners, CPE Capital, the Growth Fund, Next Capital, and even Archer Capital. Private equity refers to capital investment that is made into companies that are not publicly traded. And most PE firms are open to accredited investors or those who are deemed high net worth. And subfields of private equity include leveraged buyouts and venture capital. Funds like these require long-term focus, with an end goal being to find a fast way to make a profit whilst creating a value. So typical value add from a private equity house or venture capitalist is the provision of strategy and financial formulations, expertise and access to other global and domestic networks. A disadvantage for these types of funds is that they are often come with strings attached and you will lose a certain amount of ownership and management within the company. But then again, it also allows companies to access liquidity as a different choice compared to conventional methods, and the long-term strategic manner in which these funds invest allow for the experimentation of unique growth strategies. Typically, raising funds through VC requires a due diligence process which can take up to a year, and the costs associated with doing so can be quite a burden onto the receiving business. The nature, however, of a more private placement means that the funding process can take much less time and money. Private equity really enables companies to better exploit that potential, driving development and utilising the expertise that comes from the investor. There are also various strategies that private equity use. And these include leveraged buyouts, meaning that the business is acquired from its current shareholders with a combination of financial leverage as well as equity. The shareholders take on some of the debt in order to invest more in a certain business, to gain more control to restructure, in order to then sell it for a profit. These businesses have normally been operational for quite a while, whilst generating a decent operating cash flow. The other is the growth capital, and this is where investments are made into companies that need to expand into new markets, restructure or finance their own acquisitions. And it's true growth of an already mature and profitable company that needs those extra funds to make these transformations. Then we have mezzanine capital, and this is a hybrid of both debt and equity financing. It is a loan, but it allows for the borrowing of larger amounts of funds than you could from a traditional bank, and usually at 100% of what is required. This debt also usually comes with a longer return period, but the lender therefore has the option of converting this investment into equity or even into ownership. And then the last is venture capital, or VC. And this is where the lender also provides a business much similar to private equity, the financial resources, along with the breadth of knowledge, in turn for an equity share. The VC will always have an exit strategy. And this is usually no longer than a 5-year plan. So they get in, they grow the business to a fast and high profit, and then they sell out to make a substantial return on that investment. They will help the company to go public or merge, but the end goal for the VC is always on the quick returns. So at the end of the day, it really comes down to the stage that your business is in. Are you just an idea? Are you looking to develop your product? Are you looking to grow? Are you looking to expand into new markets, or are you ready to merge and be acquired as part of your own exit strategy? As well, for someone looking for investment, really be clear on your direction and what you want from that investment. Are you looking for straight funds, or are you looking for support and knowledge that comes alongside with it? Because there are, of course, advantages and disadvantages for both. So be clear on the direction you want to take and ensure that your investor is actually invested in that same goal that you have. It's also Therefore, a really good idea to seek a mentor or advisor that can assist you to navigate a clear path with you when you're at this stage of seeking funds, whether that be from grant money, crowdfunding, angels, or private equity. Because at the end of the day, whilst the business is still in your hands, the decisions are still yours. But by taking on an investor, you need to be prepared to let go of a certain level of control. So thank you very much for your time and attention today. If you do have any follow-up questions, please email them to me. My email address is at the bottom of the screen, and I will be happy to assist wherever I can. Thank you very much.